Joe, next year, 2026, you'll have been a quant for 40 years. How has the industry changed from when you first started?
So I started at Salomon Brothers. Salomon Brothers was the cool place to be in Wall Street. It was like working at a cartoon. So it was bigger than life people. So we were in the business of actually inventing things. In those days, academia was not where the intellectual work was happening. It was actually in the sell side in Wall Street. People investing really just figured out how to do regression. And so the traders at Salomon, he said, no one wants to hear about what's going on when you make money. If you lose my money, I want you to tell me exactly why that happened. The point he was making is that you have to understand at an intuitive level what's going on because stuff happens. A lot of these models become more sophisticated and more capable, but every model breaks.
Joe, thank you so much for doing this. Next year, 2026, you'll have been a quant for 40 years. How has the industry changed from when you first started?
Wow. Okay. Not a lot. No, quite a lot, actually. So I started at Salomon Brothers. Salomon Brothers was the cool place to be in Wall Street. And that was my second career. So I started right at the 87 crash. And it was actually a pretty wonderful time in Wall Street. I mean, at least for me, I was at Salomon Brothers, which was a wonderful place to have been. It was kind of like a cartoon in many respects. So we were in the business of actually inventing things. In those days, academia was not where the intellectual work was happening. It was actually in the sell side in Wall Street. And Salomon Brothers was kind of that, and Goldman was kind of second place in that time. And it was, so we did a lot of, we started a group. Eric Sorensen started the group. He's CEO of Panagora right now, who's my boss and my mentor. And we started that topic. And what was kind of cool in Wall Street was that it let you do kind of really powerful things. So we did a lot of work on factors, for example, how. So the idea of robust statistics was not really known. At that time, in terms of factors in Wall Street, there was Barra, not in Wall Street, in investing. So the early quants used Barra as a factor-based risk model. And that was good. It was based on fundamental factors and it was good and successful. Barra Rosenberg set it up. So we decided to do a macro version of that based on things like interest rates and things of that sort. And we did it in kind of a cool statistical way using robust statistics. It was kind of wonderful at that time in Wall Street. I'm talking about now, early 90s. People were kind of investing really kind of figured out how to do regression. You know, so to do robust statistics was kind of weird. So we set up this cool factor model and embodied it in a PC software called StockFacts Pro, which is one of the first ways to do programs with risk management. So it was kind of cool. At the same time, actually before that, machine learning kind of didn't get started. Leo Breiman at Berkeley published his CART monograph in '84, and no one picked it up. But Salomon Brothers was, Wall Street in general, but Salomon in particular, was really great in that you kind of think hard about a lot of things. So I read his monographs, and we implemented CART models, classification regression models. I did the first piece in '94 on option hedging using machine learning, the CART. Hard to believe that. We ended up using it at Salomon Brothers in many applications, asset allocation. The first global equity swap was done using some of these models. And sell side was different from now in that sell side was where a lot of the cool, important things were done for trading and for research. And the way research was configured was that the clients often didn't have the resources that the sell side had. So you did the wonderful stuff. And you recommended the ideas, and the clients did the ideas around that. And so factor modeling was then available in risk modeling, and Barra was really the important thing for analysis. And then the tech crash happened in 2000. This was, I think, for many people, this maybe before they were born, but that was a pretty important event. And what happened to a lot of funds, well, they kind of got screwed because the risk models didn't work. And one of the reasons it didn't work is because they were too slow. Okay. And so the way these risk models work is you have your portfolio, and there are a bunch of factors that drive markets, and you do covariance estimation. Well, you kind of get a slab of data to work on, and you have to have you make some judgments. And the way it was set up, it wasn't set up for a high volatility environment. So one of the things that happened, interestingly, beginning of this century, which wasn't true before this century, is that things sped up, which they're speeding up now. But you can actually see this in data and how momentum, where a lot of factors changed qualitatively after 2000. And that's not just academic. As I said, a lot of money was being managed in terms of risk for Barra, and they were too slow. And there's a really bit of a crisis on buy side because the models were just leaving them in big trouble. So then a separate development's going on in quant with Garch modeling, which is, and I'm familiar with this, you basically, so one of the things about Salomon Brothers where I was is that Rob Engel, I happened to work with him there as a consultant, and he ended up going to win the Nobel Prize. And we worked together in Garch models for a while, and what's kind of cool is that there's this problem, quants, the risk models work, but they're too slow for the markets that were developing after the tech crisis. So a lot of the risk models started to implement faster models to implement the Garch technology. So I'm kind of describing a little bit is how markets are evolving, and quants were adapting, and there was there wasn't a lot of sophistication in the early 90s. So as the time went on in the machine learning world, there were further developments. Again, Brian was one of the leaders on this topic. The machine learning technology started to involve in so-called ensemble techniques, basically kind of wisdom of crowds from models. So I guess in the 2000s, the development of machine learning, which we incorporated in some work, were some of these boosting models. So in general, as machine learning became more part of quant modeling, the sophistication grew, but the intuition maybe didn't grow in terms of the drivers. And that you may think that's not important, but I think it's really important. Let me bring you back to Salomon Brothers and some experience there. So Eric and I, we started this group, I can't tell you, it was a long time ago, about 1990. We did systematic work, and it was cool. So head of trading said to us, he said, no one wants to hear about what's going on when you make money. But if you lose my money, I want you to tell me exactly why that happened. The point he was making is that to us, which is still a valid point, is that you have to understand at an intuitive level what's going on, because stuff happens. And if you don't understand why you're broke, typically the money you're using is not yours, it's some client's money. It could be internal money, it could even be your money, but you have to understand that. So that lesson, I think, is relevant for machine learning and AI as well. So I just want to bring about around the force. A lot of these models become more sophisticated and more capable, but every model breaks and everything fails. And one perspective on that is, things change, but I'm not sure that's good enough. So you have to understand these things. So that's kind of an interesting tension between being a quant and understanding what's going on. But in terms of revenues to a bank, a lot of the revenues are if you get clients who use your models. That's good. I mean, and that's not good. It's very good. So if I asked you, Ethan, how are quants doing? I mean, you can tell me to the tick how the S&P is doing. You can't tell me how quants are doing. There's no data on that. So we had a database, which was kind of cool, where we knew a lot of quants because we were sell side, and there was data about how they did, and we were able to track quant performance, which is kind of important. And I'm doing it now because I've left the bank. It's required some rigor to do that, but based on that, it was very important to know how quants are doing, and more importantly, why are they doing what they're doing? So it turns out, intuitively, you would think about the way factors became in the world, but most quants just scratch a quant. They say, I'll do value momentum, at least a cash quant. Be quiet and they deploy it, et cetera, et cetera. It turns out, in aggregate, quants are value investors. And there was a period after the '08 crisis where just value didn't work for about a decade. And one of the charts we drew, which is kind of instructive on the topic, was we took a value index and overlaid that with the aggregate performance of quant funds based on our database. And they're kind of the same thing. So it turns out another dimension of factor modeling was the fact that your factors are part of the world. Interest rates matter, and politics matter, and uncertainty matters, et cetera, et cetera. So a lot of quants, I guess they come out of physics or math, and they treat it as a lab experiment. But there's kind of interesting things about finance. One of the reasons I got into it is because it's not a lab experiment. It's part of the world. It was on the front page of the FT or Wall Street Journal. Matters for your models. And what happens at Jackson Hole matters for your models. And what quants will do sometimes is, it's alpha decay, or it just stopped working. And what's lost is that, why is it not working? So in my trajectory, I was started Salomon, and I was ran quant at Morgan Stanley, and then UBS, and then the last big bank was Nomura. So Nomura we used to look at earnings calls. So the big transformation that happened, not so much 2007, it didn't happen immediately, but around 2020 or thereabouts, so 2019, 2018, was the ability to do really, really important things around text. And text could be earnings calls, it could be 10Ks, it could be Fed minutes, it could be whatever. So the way we used it was analyze sentiment and earnings calls, and it was kind of great. For example, you will learn that the shorter the earnings call, you have an earnings call, the shorter the better in terms of alpha, the clearer the better. Analyst conversations were more important than CIO conversations, and you can see, there's a product now. Ronan Feldman is the guy who worked with us, has now a product in that. Ravenpack has an older product about that. So that's kind of great, and there was just a recent amazing innovation out of BlackRock. Everyone's buzz about using LLMs for trading. So that's a sea change in many things, and that's, again, a qualitative change. I'm never trying to catch up on that. I think there's still an issue there in understanding. To understand what's happening is important, and I haven't seen AIs doing the following. It's just an example of what's going on today. So last night, NVIDIA reported earnings, and the expectations were high, and I didn't look now, but NVIDIA's not crashing. NVIDIA had great sales earnings growth. Okay, I don't know what's now. I don't know where you're going to air this podcast. And what NVIDIA did was had really spectacular earnings, sales, revenue growth. Okay, so one of the things the AI didn't do, which I was able to do, it turns out around a year ago, earnings growth was good, but sales growth became really good. So there was a change in emphasis by the market, and the earnings growth became more important than earnings growth. And around May, earnings growth became a negative. So in tech stocks, earnings growth was actually, if you had a high earnings growth, historical earnings growth, okay, we get it. If you had high sales growth, wonderful. So that switch meant, so what does that mean? And so AI, so that just looking at the charts and what's that mean? What's that mean? Is that an alpha decay? No. What's going on? So we think of what's going on there. What's going on there is the market's just saying, well, they'll get it going forward. The sales growth is what matters. They'll get the earnings in the future. And that's exactly what you see going on in the media reports in the video. I don't know it'll happen a week from now or even this afternoon. But the point I'm making is that kind of thinking about what's going on in the market, I still don't see AI doing that yet. So anyway, it's sort of a development that has to come. But
no, yeah, there's a lot that's happened over the years, and some of the stories you talk about are stories that happen within the markets, within quant investing, sell side, buy side, way before I was born. I mean, I was born in 2004. So you're talking about, you starting your career in 87, and then
that was my second career, actually.
Your second career, and then I
was a research scientist before that.
You were a research scientist before that, and then And so thank you for sharing that. It's a new picture of quant history that I haven't fully heard about before. I guess my question now is, given that you've lived through all these different, you've had a career in quant on the sell side, through all these different periods, this quant winter, where factors have performed differently, different regimes were in, different factors performed better than others. I'm curious how that's taught you to think about the drivers in the market. Because let's say, I'll talk about a period like 2007, where for a week, the quant funds, the desks within the big sell side banks were getting ravaged. How have all of these periods of time, periods of crisis, taught you to think about risk in your models? Because it seems to me that you don't know what you don't know. And if an event hasn't happened, you can't really learn from it. Let me get your thoughts on that. I'd love to hear more.
Well, I mean, it's interesting. Risk is really important. And so the '07 crisis was basically kind of a concentration liquidity risk. Stuff happened and people were concentrated. But I think the more general point is that there stuff happens, and it's worth being mindful of why it's happening. You can't predict them, but you have to understand what's going on. Sometimes you're fortunate and be able to have a slow-moving factor. Rates are a good example of that. The impact of rates, it's still debated a bit, but one of the hallmarks, certainly since the '07 crisis, one of the hallmarks of what's driving things is how interest rates are moving, just the print and stuff like that. But it's clearly impactful, and I don't think a lot of so how does that affect things? Is there some uber factor driving things? And I think there is some evidence there is. So can you predict it? Maybe not. But it's sort of interesting. Even the Fed has something, he's going to call nowcasting. No. I mean, even people talk about it, it's very hard to know the future, but at least you can know what's going on now. Okay. And that's really important. So what I'm saying is that as quants become more enmeshed in AI, which they are doing, correctly so. I mean, it's just a marvelous thing to and I use it. I mean, it's great. But you have to keep your head in what's going on and understand what's going on. And you have to understand things. That's kind of what I kind of do my metaphor is how to understand things. So I think quants should not treat it as a physics problem necessarily or a math problem. I mean, some areas, and I think one of the great things about quant, there's so many different avenues for it. So I guess for market structure, maybe yes, maybe no, but for more cash investing, for option pricing, things of that sort, the world's so connected is sort of a trivial thing to say out loud. And it may be difficult to quantitatively model it, but what you can do is represent it. And what I mean by that, I mean, everyone does trivially do a chart, right? Why do you do a chart? Because you want to represent the data in a way you can understand it, right? And I think you want to generalize that point to understand, and when I say, I mean understand, what's happening. And you can't always understand what's happening, but I think it's inadequate to say, the market stopped working. Value stopped working for a decade, by some measures. What does that mean? And there's a lot of discussion about that. They don't, but it's important conversation. So again, if you're in micro-market structure, I'm not sure, maybe less important. But more generally, it's really important. And I think that's underappreciated. It's one of my soapboxes after spending time in the markets, just to understand what's going on, especially as things get so sophisticated. And so maybe away from intuition. That's maybe that's the idea.
One of the things that factors give us, and you touched on it earlier, is this ability to, it's a new angle a different angle to analyze the markets. Seeing the markets as being composed of these fundamental drivers. You touched on why value stopped working for 10 years. And they allow us to ask questions about, ask better questions about what's happening. I want to ask you a little bit about the beginning of that, because I think after, the first part of this conversation, you touched a little bit on how you were involved in the launching of the first factor ETFs. What was the thinking that ultimately led to the beginning of that? And how has specifically factor modeling evolved from then to, even now? I think you wrote a paper on how machine ML techniques can be applied to time factors or predict them. How has that whole dynamic evolved?
Well, the beginning was a risk management exercise, which is an important one. As I said, so Barra was very early and very successful and very correct, except for the speed problem I mentioned during the tech crash. In thinking about every portfolio has exposures, and you want to manage those exposures. So someone has some idea about a stock or about a sector, and you buy, then you put it in the portfolio, but it creates exposures. You want to risk manage that. So it evolved from that. This is what Dave Underwood was trying to do at this pension fund, was to be able to maybe tilt the factors. Okay, so factor tilting a portfolio. So it's not quite the same, or maybe it is the same, but it's a little bit of a thing we're thinking about, rather than saying, here's a factor, it's really cool, it's going to drive my stocks, let me score them. It's a little bit different in that there's a portfolio, and it may be even created by fundamental, idiosyncratic views, but in aggregate, there are a set of exposures, and maybe in aggregate, you say, that's cool, but you know what, in aggregate, that guy's got a big value tilt, and that's kind of stupid. I want to have a whatever, So you can basically overlay things. So the idea of overlaying things on portfolios was a big capability and a big opportunity. And it still is, So the idea of having a portfolio created based on some whatever, and then in aggregate you have a portfolio with exposures and you tilt around them. So that exists and that has existed, and that's fine. By the way, I didn't mention around that the whole huge topic of active versus passive, which also gets into this conference a little bit, in that, so you have a portfolio, right? You have a benchmark, right? So what's your job? Beat the benchmark, right? What does that mean? Then you get into this whole issue of how much risk are you taking relative to benchmark. So you think about the way the ecosystem works in fund management, in that at the end of the day, there's how's the S&P done? How have you done? That kind of thing. So you have to, so a lot of factor modeling is around that topic, not so much raw, can I make money with this factor, but can I beat the benchmark with this portfolio?
Fascinating. I guess now I'd like to hear more about culture. You worked at Salomon, you worked at Morgan Stanley, you worked at UBS, you worked at Nomura most recently. How has that cultural aspect evolved over the years? You talked a little bit about Salomon, how Liar's Poker is actually very accurate on the way things were there. And I remember talking about the bond traders and the pits, and it seems like a completely different world. Yeah, but how was that like? How Salomon to UBS, to Morgan Stanley to UBS, to Nomura.
I would say every company has a different culture. So it's hard to know whether it's changing over time or changing over companies. So it's sort of the space-time continuum of finance, I guess. Salomon was, in my view, kind of a special place, highly political. I was very fortunate having my boss, Eric Sorens, who's really master of, he's a great quant, everything. He mastered all the, so it could have been a rough place, but it was a marvelous place. He had just, so the culture was one, and Marty Leibowitz, who ran research, was a big part of that as well, and that the culture was one where innovation was really a key. He had a lot of, cartoon characters there. As I said, I was often told it was like working at a cartoon. Something that was so bigger to life people. And again, read Liar's Poker. It's really quite, for those times, it's really fairly accurate. But I learned a lot. I did a lot. Clients respected it. It was just a marvelous thing. So then I left there to Morgan Stanley. Morgan Stanley was a different culture, a little more, I would use the word polished. Is that the way to say it? A little different style. salespeople were a little different. So again, as a quant and sell side, for everyone in the world, marketing is how do you get your idea out there to be known? You want a job, whatever it is. So Morgan Stanley was really, really good in terms of getting the word out. They had this classic morning meeting, which they had it at Salomon Brothers, but at Morgan Stanley, every morning they had a meeting with famous character Byron Wien. I don't know if the name's familiar to him. Barton Big, they're probably familiar. Remember these names. There's kind of Steve Roach. We get up in front of the sales floor globally, broadcast around the world for half an hour every Monday morning. And I was fortunate to be in some of those meetings, and the sales force go out. So it was a way. The point I'm making is it was a great way to have the world of quant buy side know what you're doing. So Morgan Stanley was very polished around that very very sophisticated. It was very good, very connected. As a quant, you got to see quants all over the world. In Japan and Europe, it was just marvelous. Morgan Stanley was very big on that thing. UBS also globally pretty connected. A little bit of a Me Too kind of thing. They were in the early 2000s in the business of catching up. So Morgan Stanley got whacked by the tech crash is kind of what happened, and so they got overextended. They got a bit hurt there a little bit. So UBS came in and tried to come into the U.S. and they were trying to they were very aggressive. If you go to their trading floor, I don't know who uses it now, but in Greenwich, Connecticut. So we were based in New York City, but Greenwich, Connecticut was Stamford, Connecticut is the world's largest trading floor. Now, why do you need the world's largest trading floor in the world of technology? You tell me. But it was kind of a big deal because Salomon, going back to one of the things about Salomon Brothers was it was really impressive, and the trading floor was extraordinary. Again, I don't think there are any movies of this. They talk about it a little bit in Large Poker, but mahogany walls, and you used to be on the trading floor and I look up and see they have visitors from all over the world looking down, and there's John Goodfriend sitting at the desk with his big cigar, and it was like out of a movie, and it was like working in a cartoon. It was just extraordinary. I remember when I didn't go on about this. My first job interview at Salomon Brothers, I was a quant. I was from research. I was a research scientist. I came in because they were trying to get quants in. So my interview, I read with Lou Margolis, who was the head of programs at Salomon Brothers, and he said, "Oh, let's sit next to me." And there was a market open. I'd never been on a trading floor before, and it was market open. It was chaotic. It was chaos, craziness. It was just, I'm looking at this, what's going on here, and it was just so much energy. It's unbelievable. So I think UBS tried to create the energy. Salomon Brothers' strength was just raw energy, which is great. And the sounds communicated. And they would move the trading desks around to highlight the interactivity of the sounds. And it was a really quite interesting cultural issue. UBS, they didn't kind of whatever. So UBS was interesting. They had other issues. A little less quant oriented. So Salomon was very quant. Morgan Stanley was a mixture of things, very technology oriented. UBS was a little bit different. It was pretty good. It had a good team, very good global connection. And Nomura was interesting too. They had a lot of transition. Nomura kept changing, particularly after the 08 crisis. So Nomura went through some transitions. It was very, very directed out of Japan, and then a little bit more Western, a little bit more you live longer kind of thing. It was a little bit less crazy. So I would say, in short, the cultures were very different. I'm sure every bank every hedge fund is a different culture. Whether it's a function of the place or the time, it's hard to know. But they were all fun. It's just, and I think I'm not sure it exists that way now, but that's a short story. Yeah.
Oh no, I'm sure. And I think out of the 4 firms you worked at, the one that sounds most interesting and the one that I think me and I and a lot of others who've just read Liar's Poker, watched some YouTube videos, that sounds like the real interesting one. I guess I want to talk about you've been in the space for next year, 40 years. And as you mentioned at the start of the conversation, back then it was kind of like being in a candy store. There was so much that hadn't been explored. I imagine far less data about it. I mean, now there's alternative data. I had Vinesh Jha on, and he sells a lot of it. Plenty of daters plenty of vendors rather who sell alternative data. And I want to hear your take on that. How has the quant landscape changed in that sense? You know, with the explosion of all these different tools that you were a pioneer in some of them, your colleagues are pioneers in others. How has that changed the landscape for quants today? And where do you think, let's call it, most of the edge will come from, given that we have all these new tools? Do you think it comes from the expansion of that and creating more tools, or the thoughtful application of these complex new technologies?
So it's interesting about the data. So you heard there's a guy, you may have heard of him, Michael Bloomberg. Maybe you heard of him. So he actually set up the data at Salomon Brothers. I mean, I don't know if you know about his career trajectory. He was the Salomon Brothers head of equities, and then it was a political fight. So they made him head of data. It's a long story, but the point I'm making is that one of the things about Salomon that made it so interesting is they had just unbelievable data. I mean, anything you could think of, you could just have, in terms of, they didn't have alternative data, they have anything in any market immediately accessible. It was just really, really extraordinary. And the buy side didn't have that, but Salomon Brothers did have that. And of course, Bloomberg went off and started Bloomberg. But his prototype was what he did at Salomon Brothers, which was just amazing, and amazing technology. And as I said, when I incorporated with some tools, some S+, which was great. So for a while, the sell side had a lock on that. Morgan Stanley also, I think not as good as Salomon, but pretty good as well. So a lot of data was available, not so much on the buy side. And it was kind of mystified me, because we would do a back test or a factor, and they would gobble it up because they didn't have the data. It's like, really? You have $50 billion in the minute, you know the data. But that's changed. Data has become more available, and I think there's been a shift of I guess a center of power shift or whatever. So the buy side does have data now. Although, yes and no, because again, when I do a factor history, I'm still amazed that people don't know what has happened, know what's going on. How is free cash flow done as a factor in tech? I mean, people probably have no idea. They still put in the model. So that still is an issue in my opinion. But it's getting better on the buy side as well. Alternative data is important. I think that it clearly is important. The tools are a really interesting feature because, again, one of my legs up was using the tools. That's become more available. People become more sophisticated. The tools have become easier to use, and the LLMs are a good example of that. So I think that's really important. They're going to be empowering. As I said, in my opinion, the thing yet to be done is really good data. I'll call it data understanding technology. Maybe it's data visualization, but that'll come. I mean, that's kind of what I'm looking at. So it is becoming more abundant for quants on buy side, certainly in hedge funds, although still less than you would think. So again, to your question, good quality data, and that's really an important part of it too. Like a point in time is a good example of that. So the point in time story about fundamental data, that the vendors would just take the data and they didn't realize it has to be point in time. So some smart fellow was collecting the papers, whatever, and he put together a business with the point in time data. So that's, so there's been sophistication, so data is more available. So a lot of the data costs, a lot of companies' costs are for data that's quality. So quality data has become more available, really important, but really available now if you're willing to pay for it. And there are people making it more cheap. So I would say, being a little long-winded, tools are key, quality data is key, alternative data, obviously like Vinesh is doing, is really key. And I think the main thing that's important in all of this, which can be lost, is at the end of the day, there's a person who has to explain it to someone who has the money to put into the process. And again, going back to this early trader, you have to tell him why he lost money. And so you have to understand what's going on, and that should not be lost. But I think it's really becoming richer, obviously more competitive. But it's such a big world. There's so many, and I've touched on a couple of instances where it's not just, can I build a better alpha model for this particular asset? That's true, that's important, but there are many other issues that a quant adds value that it's easier now, but correspondingly more competitive.
The nature of the markets is that if everyone's implementing the same thing, there's no edge there. And so I think it makes sense to think that quants today are trying to find sophisticated ways of applying these new techniques to find edge that others don't have access to or haven't thought of yet. Now, I have a question about, and going back to what the trader at Salomon said, or was he the head? Sorry, I forgot. But
It's not.
yeah. Just you have to understand why you lost money. Do you think that today there is this risk that because we are trying to pursue complex ways of applying these new technologies, and maybe we're not fully concerned with interpretability, do you think that can lead, and do you think that can and will lead to risks in the future for a lot of systematic hedge funds on the buy side? What do you think?
Yeah, I think that is an issue. I mean, markets, it's always crashes coming. I mean, it happens maybe every 10 years, maybe less. So I think it's definitely a problem. I mean, I've seen it, you've seen it happen. I mean, even just recent, whatever, pick your favorite crisis over the last few years. I think people are still trying to parse what happened in the '07 crash to quants. I mean, everyone has theories. If everyone fails together, maybe it's less of a problem. In other words, if there's a systemic crash to the market, okay, yeah, what are you going to do? But if your particular strategy fails, you're probably going to get fired, maybe not. So it's an idiosyncratic issue. If everyone fails, well, everyone fails. Although maybe that's also an issue. And if you're supposed to be long, short, market neutral, but why did you fail? You're market neutral. I don't get it. That kind of thing. So why did your model fail? What's your downside risk, and how do you? So there are many examples of that. The people who last longest are the ones who manage their downside. And one of the downside things to manage is explainability. And I know, as soon as AI became a feature, that became an issue. We saw this. I mentioned one of the appeals of CART was that it's just so intuitive. It's great. It wasn't perfect. I mean, there were a lot of issues, but as it became more sophisticated, ran first, and it got better, even out of sample across value. Yeah, it's better, but do you really know what's going on? And if you don't really know what's going on, there's always some wild exogenous thing that's going to happen that's going to surprise you. And if you don't know, if everyone gets hurt by it, oh, what are you going to do? But if you're the one who gets hurt by it, you got a problem unless you can explain it. So I think there is, I think it's important to be mindful of. And that's why in my years, that's the thing I'm focused on a lot. Just data, I would call understanding, and their visualization techniques. But I don't see that being an emphasis as much. I've seen a lot of cool excitement, appropriately so, about the LLM capability. But I think that has to be complemented with data understanding, or I would say process understanding. And I mean understanding, not just show me your equations. I mean understanding at an intuitive level.
One of the things that I find very interesting, and you said it a little bit earlier, about you failing versus alone versus failing with the rest of the market, is I find that a lot of the market neutral hedge funds use market neutral as an advertising technique. Whereas, and obviously it takes skill to be up every year as a discretionary fund manager and being market neutral. But at the same time, if the market's up big and you're down, I think that can be very, very brutal. And so I guess I want to hear it from you. given that you've been a quant for 40 years, and I guess it's more about your take on discretionary investing. Do you like the structure of, let's say, all of the big pod shops who go market neutral, go factor neutral, cross the trades from different managers, whatnot, and allow the economies to scale? Do you think that that's a sustainable business model that they will keep as they have been able to keep doing and be successful in doing that? Or do you think that at some point what they are doing is discretionary and they can run that, they can just run it as a, like, I guess my real question is, do you think that all these different sophisticated risk management and going factor neutral, do you think that that will hold up in the future where we don't know what we don't know?
So you're saying, is there an alternative model to the pod shop that'll be more effective? Is that basically the question?
Yeah, or really, like, are they really effectively managing risk by going, I mean, they are able to minimize the volatility, but is that truly, from a quant's perspective, would you say that they're managing risk extremely effectively?
Well, I mean, think about what they're doing. What's Millennium doing? What's Citadel doing? They're diversifying the risk. I mean, Citadel may be more so becoming a market maker, just going different businesses. It's just classic diversification. So from the Millennium point of view, or Citadel point of view, it's great. I mean, the more pods that think they're independent, maybe they're not. I'm sure they're monitoring that at the aggregate level, the better. And they're all, I know some of the people there. I mean, the clients, and they're smart. And there's an attention span of management. So in some sense, the company has a portfolio that they're managing. So they're risk managing their portfolio. Their portfolio happens to be portfolios. As long as it's well diversified, and that's an empirical question. I think it's sustainable. I think it's a good model. I mean, it's proven to be a successful model. The problem you have, if you're a young quant or a startup quant, is how do you get access to capital? Because it's a successful model, and if you're going to raise capital, why should anyone give money to you and not to a place to maybe diversify the risk? So that's an issue for those external. But I think it's a very good model. Again, Schoenfeld's another one. If you can create that structure, I think it's a good structure, and it's proven to be. So I think it's fine. I don't see that being a problem. I mean, so it's a self-learning thing. Individual pods may or may not succeed. Well, the Uber corporation sees what's going on, so they can learn from that. So it's just an extraordinary structure, actually. I mean, you have smart people, each trying to beat the hell out of the guy in the pod next to him, and trying to be different from him. And and I found, in some sense, the question is, but let me not go there. How fun it is to be in that setting, but I think from the sustainability of the business model, I think yes, I think it's a really good model, actually. And
you touched on something earlier of, like, for the young quants who were just starting out. I guess I have a question for you, as having been in the space for almost 40 years. You've worked with all sorts of people, on the sell side, and then I'm plenty of clients on the buy side. And so you've met all the top people in this industry. You've been around for a long time in this industry. What has made the people who are not only exceptional in this space, but are able to adapt to the new stuff that's coming out? What has made the people who are exceptional and continuously at the top of their game, like, over and over and over again, year after year after year?
I mean, it's hard to speak in generalities. I'm not sure I meet all the people. I think it's like anything, an intellectual or an interest and fun and joy. I mean, in other words, is it fun? I mean, there's money, clearly, but that's not all. Do you find it stimulating? Are the people you're meeting? I mean, like, one of the fun things about, at least my experience, and I've been maybe very fortunate, is you meet people who are really smart, really interesting, and you can learn from them. So the interest in always learning and always interacting. And I think the people who are continuing are always curious. There are different ways of exercising that. I don't think it's, maybe I'm wrong. I don't think it's just the money. I think there's why is Mark Zuckerberg still why does Elon Musk keep doing this? It's not, why does he keep doing this? Why does they do this because they feel, I'm guessing for them, but you feel effective doing something you know how to do well. And that means always adapting. So I don't think it's not a unique problem for finance. I think it's general. If you look around the people who are clearly don't need to do this anymore, why do they keep doing this? And they keep doing this because it's fun. They like to challenge, that kind of thing. So I don't think it's a different question for Quants than for anyone else who clearly doesn't have to do this anymore.
100%. Obsession in any endeavor will most likely lead to excellence. And I feel like the only way to really be obsessed about something is to enjoy it.
Yeah.
Right?
By the way, it's a cultural thing too. When I say enjoy it, it's not just the intellectual part. It's also I wouldn't say, maybe it's not the social part, but the style. I remember when I first went to Salomon Brothers, and I came from Exxon. I was a research scientist there. I was like, wow, this is cool, trading floor, that kind of thing. So there's something about it. It's like people join the circus. Why do you join the circus? Because you like being in the circus. I don't know. People go to theater. Why do you go to theater? I want to be on stage. So a lot of fields you go into, there's a cultural dimension to it that attracts you. Why do people go into theater or whatever it is, or art? It's not just the narrow thing you're doing. It's the whole cultural dimension to it which appeals to you. And I think there's a dimension of that for people who succeed in quant as well.
Are there any personal life lessons that your 40-year career, I guess, building the models, given your background in mathematical psychology, are there any personal lessons that you've been able to apply in your work? And also, are there any, I guess, aspects of your work, I guess, niche ideas that have taught you about life? And I guess that's a weird question, but I am curious.
Wow, that's a big question. Taught you about life. Well, there are always people smarter than you. That's important to know. I mean, like I see it now with the just right now, for example, there's a raging debate, not a rage, there's a debate now about complexity. I don't know if you're aware of this. There's an issue. There's the fellow with Kelly's name, KQR in Yale, wrote a piece about gajillion parameter model that does some blah, blah. So I got the paper and read it, and I said, that's really not something I can go through in the afternoon, So you get humble, is my point. So the life lesson is that the people, I have an impression about that. I think it's wrong. That's a separate conversation. But you look at it and say, wow, I'm impressed with what he did. I don't agree with the conclusion, but to be humbled about things. There are people smarter than you. And it's one thing I've always been very, very blessed with good teams who work with me and good mentors. So the point is that the lesson in life is to try to have people you work with who are smarter than you, so you can learn from them. And that's not hard to come by, for my case. So that's the life lesson. In terms of my work, I mean, it's always something new to learn. It's just fun. Is it, I think about it, going back to the S+ days, I mean, when I started that, it was like machine. There was a lot of early coding. So, wow, what a pleasure this is. So there's a point that Jim Simons made. I don't know if you know, that one of the things that motivated him was beauty. There was an aesthetic quality in everything he did. And that could be starting a company. There's something that's just right. It just feels right. So when I started using S+, which became ours, it just feels right. You know what I'm saying? So there's an aesthetic dimension to doing things. And if it's a personal thing, what appeals to you. But if you let that, and that's part of the fun part, but if you can be guided by what is it fun? What do you find aesthetically pleasing? And that could be a math approach. It could be, for some people, it could be doing some topology, and who knows. And for some people, it could be visualization. But the aesthetic dimension, I would say, should not be ignored. So having people around you who are at least smarter than you and talk to about that. And the aesthetic dimension, I think is an important part of the work you do. It's got to be fun, but not just fun, but aesthetically pleasing. And Jim Simon's point was the very way, it's got to be pleasing I'll pull it back a little bit, in a way that has appealing feeling to it. When I see a chart that makes a point, say, wow. When I do a piece, when I've done a piece, and even now when I do a piece and I say, wow, that's really interesting. So what am I reacting to? Am I reacting to the numbers? Am I reacting to, wow, you can make $1 jillion in this? Or am I reacting to the fact that, wow, this represents an idea in a very nice way? Okay, there's an aesthetic dimension to it. So I would say in terms of my years, that's a quality of the work. And Jim Simon's expressed this too, in terms of he's obviously uber successful, but that's an important dimension as a life lesson. The aesthetics of what you do, which is part of the social feature, but also the intellectual feature. Maybe the money could be part of it too, but the aesthetic dimension, I think, is really key.
I think that's, out of everything Jim Simons has said, I think that is something that is super deep, and I think can be applied among many disciplines. And I think it explains part of his, as you've said, uber success. Just seeing something, the markets is, and maybe it's because he's a mathematician, but seeing the markets, which a lot of people, maybe discretionary traders, will say, oh, it's fun, but it's my opportunity to make lots of money. But I find what he said, and obviously he's been wildly successful, but him speaking about beauty, I mean, it's profound, and it's super, super interesting the way he likens that to something, modeling something deeply beautiful. In your work, how have you been able to find that beauty? And is that beauty what keeps you excited about this industry after being in it for a very long time?
I would say definitely is. I mean, even and I've been doing this for a while, so it just like now I'm doing something that I didn't do years ago. But if I find a relationship and I can represent it, I say, wow, I didn't know that before. You know what? I bet no one knows this. And you know what? This is a really cool way to represent it in a picture. I mean, it's not the Mona Lisa, but it's a cool picture. So that's, for me personally, that's an aesthetic dimension, which is really important. And when I do something, I'll hack a chart that's kind of weird. I'll hack a chart so that it looks right, and it makes the story. So the story, and it's kind of funny, but Robert Shiller, and if you familiar with his work, but he wrote about narrative economics. And his point, which I think is totally spot on, is that markets are driven by narratives. And so if I can create a representation that has a narrative to it in a concise way in a picture, for me, that's a thing of beauty. For me. Okay. And so that, for me, you can go back to CART. Let's go back decades ago. Wow, there's a tree diagram. And I can see whatever, So you say, wow. And so if you can say wow. So I guess I would say that if you can say wow about something, that's what keeps you going. I mean, it's nice to say, wow, look at my paycheck. That's cool. But, and that's episodic, and that's good. But to say wow about something that at least you didn't know before, and maybe no one knew before. So it's kind of like, almost like you're an archaeologist or, Indiana Jones, that kind of thing. But, and to see it in a way, in a represented way that has a quality that will make you say, wow, that is a pretty picture. And I'm very, in my experience, I continue to be able to try to do that. So that's what keeps me going. And I don't know if Jim Simon said the same thing. He had a different, but everyone has a different thing. I'm sure Elon Musk, when he saw SpaceX go off, he said, wow, that was his thing, beauty. So everyone who keeps going at something has something about that lets them say, wow, that's a thing of beauty. And that could be a company, it could be whatever, but that's the thing, the driver that I find keeps me motivated. And I think a lot of people probably have their own way of doing that.
If you can say wow, then it's beautiful. I love that last point. I love the metaphor of wow and trying to find those little ahas in your work. And I think that, much more than the paycheck, that is what drives anyone to pursue greatness. It's the wow factor. It's the feeling of awe when you realize something that, as you've said, no one's realized. And I think that's a great place to leave this episode. Thanks so much for doing this, Joe. I truly appreciate you taking the time and sharing your almost 40 years of experience.
Okay. Thank you. Thanks, Ethan.